What I thought we'd do is to go through the main points of liquidity for this month. Hopefully you're all on, but for some reason my Zoom controls have disappeared. But anyway, notwithstanding, the 7 key questions that we're focusing on are ones that we addressed before, and let me just run through those pretty quickly. In our view, we're seeing this V-shaped rebound both in markets and in economies. Tick that box. Second question is that has the long-term trend in world GDP slowed or quickened? In our view, it's actually quickened, given the fact that there's a lot of infrastructure spending, government fiscal boosts, etc., to probably continue through this year and into next. High street inflation will pick up. I mean, already there are some visible signs of that occurring. It's likely to be moderate for reasons that I go into. Really because the general inflation pass-through mechanism is not as intense or as elevated or amplified as it was in the 1970s. Is the dollar peaking? In our view, it definitely has peaked. It's coming down. The dollar is likely in a long-term bear market. It's not going to go down in a straight line. There'll be wobbles, but generally speaking, I think we're in for a period of maybe 5 to 7 years of weaker dollar. Is this risk on? I think for Q1, our argument's been that it is so far. We're very nervous about Q2 and Q3, largely because strong economies, which is what we're likely to get, very rarely have strong financial markets. And I think there's sort of the way to think about this is in terms of maybe the old expression, which is to say that, you know, when things look really awful, and they just turn from really awful to bad, you tend to make most of your money in markets. When things look excellent and they turn to good, just good, you lose most of your money. And so it's a question of being alert to where we are in that new cycle. In our view, that basically by Q2, Q3, economies will be back into some pretty decent state, growth being pretty good. And what we're likely to see is a lot more pressure on financial markets, not because of valuation concerns, as point 6 says. We don't think there's any evidence of a liquidity bubble yet. Maybe there are pockets emerging, but generally that's not true. It's much more about the flow of liquidity rather than the valuation. If you get strong economies, you're likely to get some sort of midterm correction simply because money is diverted from financial markets into the real economy. And then finally, are bonds a safe asset? I think the answer to that is categorically no. There's still a lot of upward pressure on bond markets. I think we're going to easily get back to 1.5% on US Treasuries relatively quickly, and the trend is already there. That may cause the Fed some concern, but I think that the underlying background is suggesting that actually yields deserve to be higher than that, maybe 2 to 2.5%. So let me continue in terms of what we're seeing. What I'm putting up in these first 2 slides are some of the input that we use for this new global macro equity fund that we run. It's a systematic fund, and it basically uses this data as input. And I think it's very interesting to see what a systematic framework would be saying right now as to about opportunities. And what it's comparing is on the top 2 slides, it's looking at GDP momentum coming from our partners in this fund, Nowcasting Economics. And on the top right is our in-house investor risk appetite indicator that is derived from the positioning, the actual positioning of investors in markets. The GDP momentum indicator basically is shown in those on the left-hand side for 2008 to 2009, and then in the current COVID crisis from January 2020 onwards. I think the 2 are interesting because they're kind of different in a way. The first occasion in the GFC, what you saw was a progressive, steady, but actually quite sort of stretched out recovery. It was really well into 2009 before the world economy had recovered back to the sort of growth level that we were seeing prior to the crisis in the early months of 2008. It then continued to expand with the stimulus that was being given. If you look at what has happened this time, the recovery has been much, much sharper and more pronounced. And if you look at the data coming into 2000, or the early 2020, before the COVID crisis hit, you'll see that growth was running on in the world economy at a level of around about 3%. The little hump you see after the first dip is about the timing of the slowdowns, split between Asia on the one hand, which went into a recessional dip first of all, and then the US and Europe, which saw the second wave down. So in that sort of W shape, the hump coming back, or the spike coming back in the W, is Asia recovering, and then the further leg down is the continuation of the falls in the US and in Europe. But round about May or late May, we saw a decisive rebound in global economic momentum, and GDP has basically gone back to the trend levels it was seeing before at around about this 2 to 3% area. There's been a little bit of a wobble around about November, early December, but the latest data which continue into January, including up-to-date data up to I think the end of last week, is showing no signs of any further dip. And I think what that's really attesting to is not really saying that Europe is not locking down or there's no adverse effects from the lockdown. It's really saying that the momentum of Asia is more than offsetting that at the moment. So Asian economies, from all the other companion indicators we get, look to be in fairly robust recovery. And as I'll go on to say, I think a large part of that is really about what's happening in China. If you look at the two charts on the right, which are risk appetite indexes, they show how risk appetite has also adapted. Now, given the fact that the zero index on that scale is a normal asset allocation, if you go below in those bands of -20, -40, they reflect respectively 1 and 2 standard deviations below normal risk positioning. So that's saying, for example, that equity positions at -20 are 1 standard deviation below normal, and at 40, -40, 2 standard deviations, etc. Now, one of the points that we've been making is that the sell-off in March was pronounced. It took us actually below levels that we saw in the 2008 crisis, if you just reflect on the chart just above on the top right. But the recovery, the rebound, has actually been a lot sharper. So we got back to those levels by June, July. There was a very sharp rebound, consistent with the economic V, I would say. In 2008-9, there was a much slower recovery in markets, really because what we were seeing was risk appetite remaining at low levels and then gradually picking up. Now, where we are back to in terms of risk positioning is about neutral levels. Now, I know that it's probably evident from a number of investor surveys that sentiment is very elevated, and I'm not going to detract from that in terms of what the feeling among investors has been. But if you look at the positioning of data, and I've noticed that other firms, in fact, some of the big investment banks have started to look at very similar data to us now, what they're showing is that risk positioning within portfolios is not wildly different from normal as we stand now. So in other words, there's scope for more equity investment to come, providing that the background looks fairly good. This chart, which I'm just going to briefly touch on, is how the systematic models basically are positioning. And what they're broadly saying is that where our models are favoring, where they think there is still opportunity, and this is right up to date, is basically saying in the UK, which still looks very undervalued, and in the commodity related markets, because the commodity related markets are going to get a further boost as the world economy picks up and commodity prices elevate further. Where we've been, or where the models are basically taking money out of, are really areas where they think that risk positioning has got slightly ahead of the economic tempo. And it may be slightly controversial to be underweight Japan or Korea right now, but I mean, this is, this is a view that's looking forward, not backwards. Let me say something very briefly about how we put this together. And I'm going to talk about our liquidity analysis very briefly, just for those that don't know. Liquidity is the main factor we look at. That drives the yield curve and it drives the exchange rate. Now, what's critical in terms of this analysis is the distinction between what the private sector is doing and what the central bank or the public sector is doing. What this dotted line is trying to illustrate is that as private sector liquidity expands, so it boosts the exchange rate and steepens the yield curve. But as central bank liquidity tends to weaken the exchange rate, but at the same time steepen the yield curve. So what you get out of this mixture are different configurations. So if you're in the top left-hand quadrant with basically saying you've got strengthening private sector liquidity and weak private sector liquidity, you tend to get a flatter yield curve but a stronger exchange rate, and that tends to work around in this sort of clockwise fashion. So if you're in this in the top right-hand quadrant, that's saying stronger exchange rate, steeper yield curve, and that's basically suggesting that private sector liquidity is dominant, is beating central bank liquidity, but central bank liquidity by that stage is actually in that quadrant has tightened. And then you get the lower right, weaker exchange rate, steeper yield curve, and then bottom left, weaker exchange rate, flatter yield curve. And then you can equally embellish this chart with different types of equities, defensive growth in the top left, defensive value in the top right, cyclical value such as materials bottom right, and then cyclical growth, drugs, technology in the bottom left. That little Snell diagram shows how markets are moving. I'm going to make that a little bit simpler by saying here is the data as we see it, and what the data, which is using private sector and central bank liquidity to draw those coordinates, is identifying is that we're effectively moving into a regime. This is focused on the US, I should hesitate to emphasize, where you're getting a steeper yield curve and you're getting a weaker exchange rate. So that's what the Snell diagram is broadly telling us right now. And again, you'll see the configuration. So that's broadly how we're seeing things in terms of liquidity. These points will be brought out a little bit later. What is the background? What is the data telling us? Here is our liquidity cycle going right back to the early 1960s. And that is an index which ranges between 0 and 100. The timeline at the bottom basically tells us how that moves through different asset classes and into the real economy with the appropriate time lags. What we're seeing now is an inflection beginning in the global liquidity cycle. That's not bad per se, but it's clearly a warning sign, because if it's peaking, it's likely coming down. And as liquidity comes down, the reasons are important. It's not because central banks are necessarily tightening, it's because the real economy is taking more and more liquidity. And that's suggesting that you should be repositioning portfolios away from interest rate sensitive areas that'll be affected adversely by bond markets selling off, and moving more towards cyclical equities, particularly commodities. What is the size of the liquidity injection? These charts just basically try and show the scale of things. And the left-hand chart is looking at a share of world GDP. And what it really does is to make the point that, look, this is an unusual and very rapid jump in liquidity. We come back to the saying, or the maybe trite saying again and again, all money that's anywhere must be somewhere. And so this liquidity is driving somewhere through the world real economy. At the moment, it's largely in financial markets, but it will migrate out. As little as maybe 20 years ago, the ratio between liquidity and GDP was barely 100%. Now it's touching 200%. And you can see the role that central banks have played on the right-hand chart in driving liquidity higher. And we suspect that this year you're likely to get very close to 180 trillion of global liquidity. What does that mean in terms of broad financial assets? Well, this chart is a very, very simple one, which looks at the growth rate of liquidity in orange, and it's just charted alongside the movement in all financial wealth, in fact, all wealth, not just financial wealth, because we include in that gold and precious metals and real estate in the sense of housing prices, residential house prices. And what that basically is telling us is that there's a very strong correlation. It's about 0.7, as the text says. And generally what you tend to find is that liquidity leads by a few months this general constellation of asset prices. And where we are now is that liquidity has shot up globally at a rate of about 20% increases year on year per annum. That's going to continue into 2021, but it's beginning to peak on a month-on-month basis. And what that is suggesting is we must be getting close to the inflection in terms of asset prices. Now, still says that asset prices go up, but we're likely to be getting out of the easy money stages now. The big booms are behind us. Let me say a little bit about the complexion of liquidity and how it's changed looking at last year versus this year. The top two pie charts are looking at central bank liquidity. Who were the main suppliers of liquidity? The bottom two charts are all sources of liquidity. So the top is a pool of about 30 odd trillion of central bank liquidity. The bottom is a pool of about 175 trillion of total liquidity. They're different clearly in size, but this is the distribution. What it's saying, and I think the key point is to look at where we've highlighted China and then emerging markets. Clearly, the US and the Eurozone have been big players in both senses. But what you're seeing is, although the US steps up again in 2021 with more liquidity or a bigger share still of the liquidity pool, it's China which has really gone, I don't know about unnoticed, but it's basically crept up. It's supplying a lot of liquidity. And too many people have been watching the PBOC alone. You can see from that top left-hand pie that the PBOC, the People's Bank, barely contributed 1% to total QE last year. But actually, Chinese liquidity miraculously provided about a fifth of the total increase. So it was more or less equivalent to what the US Fed put in, or sorry, the US financial system put in. If you look at 2021, China gets a bigger slice still. And although the US is still a dominant player here, what you're seeing is big increases from China, and the Chinese element goes up to about 34% of total liquidity provision. The other thing that jumps in 2021 is more sources of liquidity coming from emerging markets, and that's really testimony to the weakening dollar and to the policy that we think that emerging market central banks are following. So the two things to watch and what's changing is this impact that China is having. The reason that you saw this bigger increase, the 26% increase in 2020, was simply because directed lending by state-owned banks was encouraged, and there was other factors that came into the mix, such as local authority loan issuance, etc. Here is the data showing visually, where we are in terms of the impetus of liquidity. Central banks are on the left-hand chart with the US stripped out, so it's really trying to show that others are participating more fully now. And on the right-hand chart, it's showing that the private sector is really leading the charge in terms of liquidity, which is that yellow area on the right-hand chart. Why is it different than 2008? Well, I've shown these charts before, but let's just go over them once more. The scale is the big issue on the left-hand chart. What you're looking at is, just taking the US alone, the liquidity impetus or impulse that you've seen after the COVID crisis, about 5 times what you saw after 2008, just to put that into context. And then if you look at the right-hand chart, what that's illustrating is the difference between broad liquidity, or what you might call wholesale money, because a lot of that money is purely financial asset, goes into financial assets, from what we think about is retail money, or very narrow money that is going into the average person's bank account. And M1, which we show there as the yellow line, is what tends to be spent in the high street. So what you can see there is the growth rates of retail money within this mix are accelerating all the time. And that's why we're optimistic on economies for 2021. In terms of this chart, again, this is sort of background of where liquidity is changing at the margin. And you can see China and Japan, the Asian markets, are picking up at the margin. In terms of where liquidity is above average, it's still true to say that the UK and Eurozone have got lots of liquidity in them. So is the US. China is towards the bottom, Japan lower end, but they're starting to move now much more decisively in terms of their liquidity injections. You can see that from the heat map too. This is a heat map showing central bank liquidity month by month, with the numbers showing where our indexes sit. But the heat map speaks for itself. And I think what you can see is that visually from this is that central banks move with some alacrity around March, April time in terms of injecting liquidity. China didn't. China kept its foot on, covering the brake pedal, if you like, for a long time. But the Chinese row has started to go more green, as you can see lately. The emerging markets are dominated by China, which explains why that band, which is 3 down from the top, is a little bit less green than you might expect. Let me focus now a bit more on China and what the data's saying. One of the things that we hear time and time again, and many of our clients question us about, is that the consensus among the investment banks is that the PBOC is going to tighten this year. Now, I fail to see how anyone reaches that conclusion, apart from listening to the rhetoric that's coming out of Chinese ministers. And what they're saying is that they want to cap leverage. Well, if you look at their speeches, it's a little bit like listening to the Fed, that one governor says one thing and one says another. And generally, they sort of average out to a consensus. And what the Chinese authorities are saying is, on the one hand, they say they want financial stability. And then, a week later, they say they want economic stability. The problem with the Chinese model is that you almost can't have both at the same time. In the West, it's possible. But in China, it's not, because the economy has such a thirst for debt. And the only way you can really get growth in the Chinese economy is to basically boost liquidity and boost debt. Now, we addressed that in a very recent research note we put out, which is trying to explain what's going on in China. But the bottom line is that consumer spending in the Chinese economy takes a very small percentage of total GDP. It's less than 50%. And the reason for that is that China has a very bad or skewed distribution of income, where households don't get very much of the spoils. It's basically taken by the state or by the elites. And that means that you've got very low consumption. Now, there's no way that's going to change unless they change the whole political model. So forget it. But that means that you're going to have to get other sources of growth to reach the targets that China is trying to set. And the only way you can really get growth is through the state, which largely goes through infrastructure spending, or it's via export growth, which requires the yuan to be managed. So liquidity growth is really a critical factor. Now, what you can see on these two charts are, on the left-hand slide, we show total liquidity. The orange line is shadow banks. It's actually a little bit broader technically, shadow banks, because it includes local authority bond issuance. It does not include private sector bond issuance or equity issuance. It's purely local authorities. The reason being is that the banks tend to buy those local authority bonds. And so that's an extra, if you like, it's a securitization, which is a way of providing liquidity. And what has happened is that picked up very rapidly over the last few months. On top of that, if you look at the red line, that's looking at the growth rate of traditional commercial banks, particularly the state-owned banks. That's been remarkably steady over time. That's a sort of set figure. And the reason that that's given, or is an assumption, if you like, or something we can assume away, is that that's how the planning system works. If the state-owned enterprises are given targets to run, they're given the financing to do that, to provide for the inputs, and that's what the state-owned banks do. So that figure tends to be a lot less variable than the orange one. The orange one is telling you more about the tempo of the economy. And as we showed, I think, a couple of months back in a research report, if you correlate that shadow banking line with world commodity prices, it works remarkably well. The right-hand chart is then looking at the distribution of liquidity within the central bank balance sheet. 2 points to take away from that is that, number one, is that most of the control over the size of the balance sheet is now not dependent on foreign exchange reserves. They're not going to be building their foreign exchange reserves at all, I don't think, in the near future, because that demands too much of a commitment to the dollar, and they want to get off the dollar hook. So what China will do is to use other means to stimulate liquidity, and that means the black area, which is domestic asset purchases. That's really been their policy since mid-2014, and it's why PBOC watching is so important. And what you can see in the red line, which is a 6-month annualized rate of change, is that that has stepped up significantly since August of this year. You'll see that in another way if you look at this chart, which is, or these two charts, which are looking at the growth rate of the monetary base and total liquidity drawn again in 6-month annualized growth terms. And what that shows is that step up in, in monetary base growth. And the chart on the right is then looking at a rolling 6-month total of Chinese PBOC open market operations or liquidity injections. Now, we know that the consensus says, well, of course, this is not true. The Chinese are tightening. If you look at their money market operations, they're not particularly generous. In fact, that's incorrect. One of the great problems with analyzing the Chinese financial system is that 50% of the Chinese economy, or maybe, sorry, a tad less than that, but 50% is still rurally based or dominated by agriculture. So there's a very big seasonal element in Chinese monetary data, which you need to get out. And if you seasonally adjust the data, what you find is there's a much clearer trend pattern to what's going on. And what we show here is that a rolling 6-month total of liquidity injections seasonally adjusted gives us the picture on the right-hand chart, which I think shows quite well what was going on through this year and essentially what is happening in China. What does that mean for the world economy? Well, what it basically shows is the comparison between world business confidence and shipping activity in terms of how rapid the recovery has been and how brought forward it has been relative to what happened in 2008. World business confidence is simply an aggregate we put together of all the major surveys, the US ISM, the Tankan in Japan, the UK CBI, the Eurozone, various Eurozone surveys, INSEAD in France, FAS in Germany, etc. And shipping activity is a series of different indexes, the cash shipping rate index, the RWI index for container freight, shipping throughput in Singapore, and the Baltic freight indexes. And what they basically illustrate is this sharp V-shaped recovery. You can see that on the data from a longer term perspective, and we put on the left-hand chart here, which is the world business confidence one, our liquidity data, basically to show that that's in red, to show that effectively the world business cycle is dictated by these flows of liquidity, and shipping activity is really no different from what you've what you're seeing here. In terms of inflation, I want to touch on that because it's a critical issue. A lot of people are discussing it. First, inflation is material, as we show on that left-hand graph, which is looking at how valuations change as inflation moves higher on the left-hand axis. This chart is schematic, but it actually comes from actual data. So the black, red, and brown lines are actually regression fits to data that we got from the US, which actually I just downloaded from the Schiller website of US PEs, inflation, and bond yields. And so those are fitted data, but they show a very interesting picture. And that is that the peak valuation for equities comes at low inflation rates of about 2%. If you move towards deflation or higher inflation, markets derate, but there is an inflection, a sweet spot in the equity data. For the bonds, it's straightforward. More inflation means rising yields and a declining, inverted bond yield or multiple. And the same for real assets, they go the opposite way of bonds. So what this is really saying is that as inflation picks up, asset allocation is going to start to shift away from bonds, more towards real assets and more into equities proportionately. And that is, I think, what we're seeing. One of the things we figured this quarter is that you may get fears about inflation, which would accelerate that asset shift. Now, if you look at the chart on the right, that's purely plotting our global liquidity index against the US ISM prices paid component in the US with liquidity advanced by 12 months. the fit is not bad at all. It gets very close to really what happens with prices paid. And what you're looking at is the beginnings of some sort of inflation pickup. The question is, how big is that going to be? And what we've tried to do is to look at that in terms of understanding the elements of inflation that are driving the system. Now, I need to explain this data, but it's data that we derived from the US CPI series. And what we did is that we took out, we looked at core inflation, which is basically the yellow area of that chart, and we stripped out of core inflation what you would expect to occur through monetary excess. And we did that simply by looking at how asset prices, including gold, moved year by year, and through a regression just took that element out of the US core inflation numbers. And that you can see as the black area on the chart on the left. The red is simply the difference between US headline inflation and US core inflation as published by the US authorities. And basically what that shows is the yellow area is the dominant part of that series. The black, the monetary inflation bit, and a little bit of commodities or energy, which is included there, were important in the 70s. But basically it was the pass-through mechanism that was really important. Now, interestingly, if you track what's happened to the cost component, the core element, X commodities, what you find is the series you get on the right-hand chart. And what that shows is around 2010-11, we were at the absolute low point in terms of US inflationary pressures. At that point, monetary inflation, as a result of the spillover from the easing that occurred after the GFC, was actually contributing more of the inflation that we were seeing in the high street. So underlying costs were virtually flat. Obviously, some were declining, but the average was about zero. What we've seen since then is some pickup, and this carries up to latest data as of the end of 2020. What you've got there is probably an average level of cost inflation of around about somewhere between 1.5% and 2%. Monetary inflation in 2020 was relatively small. We suspect it's going to pick up this year. Maybe it would go as high as 2%. That's quite possible. So in other words, what this picture is really painting is one where you get an inflation pickup. The cost pressures are not yet anything like as severe as we were seeing in the 1970s. So the underlying level of costs are growing at around about 1.5, 2. The monetary inflation spillover is maybe at most 2. So what that would suggest is you're looking at an underlying inflation rate that maybe moves temporarily while the monetary excess is there up to about 4%. Now, bonds won't like that, but this is not a disaster. And it's suggesting that we ought to be moving more towards inflation sensitive areas within stocks, but that looks like things like commodity related areas which have already done well, but there's probably further scope. In terms of the valuation of risk assets, what these two charts are showing is the valuation of equities against all safe assets. Safe assets here are defined as G10 government bonds and cash in bank deposit accounts or money market funds. And that shows that, things are elevated. Let's not pretend they're not, but then they're nothing like as bad as we saw or as extreme as we saw in earlier instances, such as around 2000 or 2007, or even, probably comparable to what we saw back in 87 or thereabouts. And if you look at the projection to N21, using what we know or what we assume is going to happen for liquidity and for bond issuance, it comes down. If you look at a more straightforward indicator, which is looking at equity assets to all liquidity worldwide, what you find is probably a more pleasing picture, which is very difficult to suggest that there's any excess, any valuation excess right now. And if you look at the projection to N21, there's still a lot of liquidity around. And the whole point about this analysis is saying, look, all money that is anywhere must be somewhere. If money is around, it's essentially finding its way into portfolios somewhere. And if you have too many safe assets or too much liquidity, it's got to be rebalanced towards more risk taking. Let me move on to bonds. I'll come back to equities in a second, but the background for bonds is not great. And these two charts hopefully explain why. The one on the left-hand slide is basically looking at the US yield curve. I've taken the longest or one of the broadest measures, which is the 20-1 year spread. And I've looked at that against safe assets, the supply of safe assets. Now, this is unusually, perhaps, this is the sum of the Fed balance sheet and Treasury debt. So it's not Treasury debt minus what the Fed has been buying, it's actually the addition. And the reason for looking at that is that basically it's saying that QE is a source of safe assets, as is Treasury debt. And what we're looking at here is how that supply affects risk taking. And the argument being is that if there's more safe assets in the system, there's effectively more potential for leverage, more risk taking, and the yield curve should steepen. And there's actually not a bad relationship between the two. And you can see that already the yield curve is kind of reflecting that big pickup in safe asset supply. On the right-hand side, what that's saying is looking at a factor model. I've shown that over recent months as well, but basically this is just bringing it up to date. The factor model is a very simple one. Anyone could do it. It's simply a regression between the US bond market, bond yield, 10-year bond yield, and four factors, which are the US ISM, the Australian dollar, US dollar cross rate, the copper price, and the gold price. And what that shows is a remarkably close fit. And what it's saying is those are all cyclical indicators. And what that's basically saying is that yields should be a lot higher than they are right now. They should be nearer 2.5% than the circa 1% that they're trading at. This is the data here is end December, so we're really over the 1%, of course. Yield curve also responds to liquidity. Liquidity is, we think, a very good guide to the yield curve. This was always the metric or the the view that we took when I was at Salomon Brothers years ago, is that that's how you trade the yield curve. And effectively, money flows precede movements in the yield curve by around about 9 months. And what you're seeing now is evidence of a steeper yield curve. It's got further to go. I fully suspect we're going to be up at easily 150 basis points over, maybe higher. But that's really in the gift of the Fed. But I really think the Fed is going to struggle to keep yields down, but we'll see. What about the dollar? This is the other key factor for this year. And I'm going to spend, a large part of the, next 10, 15 minutes talking about currencies. What this chart or these two charts are identifying are the factors or two of the key factors we use for understanding currencies. They are the mix of liquidity between the central bank and the private sector. Most conventional analyses don't differentiate between the quality of liquidity. They lump everything together. They add the two together, and they say more liquidity in general weakens a currency, less liquidity strengthens a currency. Nice idea, but it doesn't always work. What you need to do is distinguish between the types of liquidity. Private sector liquidity is always good for currencies because it tells you about the strength of economies and the return on capital. Central bank liquidity is always bad for currencies because it's purely a supply of more paper. So you've got to look at the difference between the two. And the difference is shown on the left-hand graph, and it's plotted as the yellow line and called the Forex risk index on the right-hand chart. The deviations of the DXY from its 3-year trend are shown as the red line on that graph on the right. What you're seeing is a more noticeable drop in private sector liquidity than you're seeing in central bank liquidity. And that's largely because more money is starting to go into the real economy to supply working capital demands as economies pick up, and that's quite normal. And the Fed is still relatively easy and will likely continue to be. Therefore, what that's telling us is there's pressure, downward pressure on the dollar. It's not cataclysmic yet, but it's clearly pointing down, and the dollar looks like it's still weakening. But there's a further dimension which comes into this, which is looking at cross-border capital flows. And I know I've spoken about this before, but I want to reiterate it because it's very important. This chart on slide 25 looks at the backdrop for capital flows between the major regions. And although I've put all Europe, Asia, Americas here, you can think of this broadly as the Euro area, yen stroke yuan for Asia, and US dollar for Americas. So it's showing these capital flows. Now, they're shown as a percentage of total global liquidity for consistency. But basically what you see are the gray areas of recessions highlighted according to the National Bureau in the US. There have been 3 big periods of capital inflow into the US. One in the mid-1980s, which was when Japanese insurance companies were buying US treasuries, with some alacrity. Then you saw in the mid to late 1990s, the Asian crisis, where a lot of money moved for safety into the dollar area. And you can see correspondingly the yellow line, which is the Asian flows, went negative. So that was largely driven by that. You see money moving into the euro area prior to the commencement of the euro as that red line. And then if you move on to the post-2008 period, you'll see a huge inflow of money going into the US dollar, which is that brown line, accelerating upwards, peaking around 2016. That was contributed by 2 factors. One was the outflows of capital from China, the yellow line, which was Xi Jinping's anti-corruption drive, and also restraints on Chinese banks to stop borrowing dollars. And then you also saw the Eurozone banking crisis, where the red line basically saw a hemorrhage of capital out of Europe. Now, the other factor that fueled that boom in the dollar was that after the GFC, Basel III meant there was a huge requirement for safe assets. At the time, obviously Asian governments don't issue very much safe asset paper. European governments do, but they didn't at this time. There was a dearth of new issuance coming through. And so the only area to buy new debt really was in the US. And therefore, that explains why you've got that big peak. And the money flows into the dollar fueled the background that we've previously seen, making private sector liquidity look very buoyant. And that was why you saw the strong dollar. Now, subsequent to that, the brown line has come down. It is not yet negative, I hesitate to say, but it's moving lower. And that is really the mechanism, we think, whereby the dollar bear market is going to continue. So in our view, there's a long-term, maybe 5 to 7 year period where the dollar weakens. Now, I think you've got to put that in the context of the new administration. And I'd make just a couple of points about that. One of the things is that Biden, I think, will have memories of what happened when he was vice president under Obama. And Obama got clocked out at midterm when the elections went against him. So Biden's going to act, and he's going to act quickly, and he'll want things to work before the midterm. So there's some speed here. Secondly, I think the Democrats are going to want to win back the Trump voters, in other words, the industrial workers that were lost to Trump. And thirdly, they've basically got to deal with a Senate which is pretty evenly balanced. So it's a tough call. And I think what that does is it points to a lot more emphasis on the Federal Reserve, and probably a lot more requests by Janet Yellen to allow the dollar to weaken. And that's what I think is going to sort of square the circle in terms of all those demands. It's much easier to get stimulus via a weaker dollar and fulfill many of those aims than through traditional fiscal means. If you look at currencies, let's just focus on the 2 other areas. One is looking at the Asian units, which is shown on the left-hand slide. Now, I may be wrong in this judgment, but I find that chart remarkable in the sense that I've never seen Asian currencies, and this is a notional Pan-Asian currency unit derived from BIS data, anything like as stable as that. I mean, it's almost unbelievable. And this has to be being targeted. And that is not, that's not in the script. No one's saying that. It's going on. And if they say, if it's yellow and it quacks, it's a duck, and this looks like it. The chart on the right is actually looking at the bilateral real exchange rate between the euro and the US dollar over the long term. And I think that chart, tells us a lot about the cycles in the dollar and the euro. It's very consistent. It looks as if the euro is wanting to strengthen. I think that's entirely possible, but it comes through largely from capital outflow from the US area. What can the Europeans do about it? Nothing, I don't think. I think they lack the tools and they lack the inclination to keep the euro down. So I think the euro is the currency that really benefits, if that's the right way of putting it, from dollar weakness. The Asian currencies are not really going to move. Why is that? Because you've got two key components here. One is, what is China doing on the currency? And this may explain why the People's Bank is currently easing policy. It's not, economic stability they want or financial stability, it's currency stability. And that's the third leg of the stool that no one's really been talking about. And what you tend to find is that the PBOC is more generous in its open market operations when the yuan is strong. And what that chart on the left is trying to highlight is it seems as if China is targeting its bilateral real exchange rate, certainly against the rest of Asia. But as we saw, Asian currencies themselves are remarkably stable anyway. And what's the mechanism for that? It's monetization of foreign exchange reserves. That's how they effectively control things. Now, the Chinese are not doing that directly. They're doing it to some extent. But as I said, they don't want to accumulate too many dollars in their Forex reserves. So what you'll likely see is this policy easing going on. And what that chart is basically showing is the very, very strong correlation between foreign exchange reserve growth across the Asian economies and subsequent central bank liquidity growth, which is shown as the yellow line. The two correlate remarkably closely. So there's an R squared on the regression of over 60%. And you can see how it's operating recently with a big pickup in policy liquidity coincident with that rise in Forex reserves. So the more that the dollar weakens, the more you're going to see this mechanism in action. And there's going to be more liquidity going into the Asian economies, which is why I think you're looking at this picture, which is saying, basically strong Asian economies, strong commodity prices. Let me finish on looking at equities and what the equity data is saying. The way that we look at equities is to look at how liquidity is positioned in portfolios. You probably know the story. I've gone over this many times. But broadly, the left-hand chart is a mountainscape diagram showing the positioning of liquidity in portfolios. The percentage held in equities versus the percentage in safe assets is basically shown as the risk appetite measure on the right-hand chart. And we've charted that against world GDP growth to show that there's a very strong leading indicator between the two, or correlation and slight lead between the two. And that's basically, how we see things. And what it's telling us is that if you get a step up in world economic growth back to 3%, which is where we think we're heading, or maybe faster, what you're going to get is risk appetite basically reflecting that a couple of months before. So generally, there's still scope for risk appetite on average to pick up. Now, I think the interesting bit is to see whereabouts we are in terms of that picture. And what I'm going to do is to look first of all at a ranking of markets to try and see whereabouts we are now in terms of those risk appetite measures, market by market. Now, the chart on the left is looking at risk appetite ranked by market, with the lower numbers, the negatives, being much more attractive than the ones at the top. And this is the end December 2020 picture. The chart on the right is where we were at end March. Now, I know I've made this point before, but I'm going to make it again because it's I think, so fascinating, is that the US was the cheapest market by a long way in terms of this liquidity metric or risk appetite metric. As of end of March, it was down at -80, which on historic grounds is a minus, something like a -4 standard deviation event, which is almost unheard of statistically. And that's how much the US was undervalued. And again, I've thrown this anecdote in, which we got from Fidelity, which said that something like 30% of their account holders sold every equity they had by the middle of April 2020. And that shows what the panic was. Now, that picture on the right has changed to the one that you're now seeing on the left-hand slide. And that basically says that the markets at the bottom of that chart, which are things like South Africa, Canada, UK, Italy, Belgium, are the ones that look by far and away, the cheapest markets. And you can see the time series that I've got here, which is basically looking at how those individual charts look over time, market by market. Now, what that basically is saying is that of these markets, Japan, lower left, has moved up towards the top of the band. I mean, it's not yet at that top tram line, but it's less attractive, a lot less attractive than it was. The US is just above average, but it's nothing like the levels it was at, as recently as 2018 or back in 2007. But it was clearly there. Buying below the lower tram line makes an awful lot of sense from an equity standpoint. Selling when you're above the top tram line is equally compelling. We're not there yet, but we're getting there. Eurozone looks a tad more elevated than the US, but the market that is seriously out of line is the UK, which you can see on the bottom right-hand chart, where even despite the outperformance of UK equities in the last 2 or 3 months, it's still at very, very low levels. China, India, Russia, and Brazil, which are the BRIC markets, are shown on this next slide. What that's saying is that India's had a very strong bounce, getting towards the top of that band. Similarly with Brazil, Russia has been helped by higher oil prices, and that's gone above the area. And China is maybe of those BRIC markets the one that looks the most interesting by far. And here we have 4 of the other sort of key markets worldwide: Hong Kong, Singapore, Korea, and Thailand. And what that's saying is that, again, the Asian markets are leading the charge. Korea's had a phenomenal performance, but in terms of these risk appetite measures, we're above the top tram line. So we're starting to get out of that trade now. Hong Kong equally getting up there. The attractions are much more probably by implication here in the A shares in China rather than on the Hong Kong market. Singapore is really yet to move decisively, but it's looking more or less like the US picture, a little bit above average. Same with Thailand. So those markets have got scope to move up. So what's the summary? Summary again is basically what are we seeing? I still think big message there is the one that's in bold. Strong economies rarely have strong financial markets. There's early evidence of Chinese easing. Shadow banks are coming back into the forefront once more. Global liquidity is likely to increase this year by another 15%. And that backdrop is probably consistent with a weaker dollar. Capital outflows are definitely moving out of the dollar. The world is seeing this V-shaped rebound. Equity outperformance is, it's going to be probably continue for a tad longer. But I think Q2, Q3, I'd really want to reassess what's going on the basis that the news can't get a lot better than this. Yield curves are steepening, and that's putting up, that's making bonds look a lot more vulnerable. So I don't think bonds are a great trade at all. And I would tend to be moving much more towards real assets and commodity markets or commodity-based equities. So let me stop and see if we have any questions coming back from any of these slides. I'll see if there may be some questions as well.
Michael?
Oh yeah, hi.
Hi, Michael, it's Marcutus. You made a comment, there's a lot of questions, but I have one which I thought was, it's very short, you should be able to answer it quickly. You said that in particular, Janet Yellen will allow the dollar to weaken because that makes a lot of sense. I can see why they would want a weaker dollar, although that may come back to haunt them, given the amount of capital the US borrows from overseas. But the concept of allowing the dollar to weaken, does that suggest that someone is actually managing the dollar, or what did you mean by that?
Well, I think that I suppose the implication is yes, that's true. I mean, this can be done in a number of forms. It can be done in the sense of, open mouth operations, as well as, trying to persuade the Fed to run easier monetary stance. But I think what I'm really saying here is that, given the program that Biden's got, or likely to have, the Federal Reserve in one form or another has got to do a lot more of the heavy lifting. So there will be a requirement for the Federal Reserve to maintain QE or debt purchases this year. In actual fact, if you look at the CBO, the Congressional Budget Office projections, I mean, they still project sizable Fed purchases going on. So I think that's likely. But I think generally, as we know, inverted commas, I mean, currencies are political weapons, and governments tend to use currencies to get their way. And there is scope, particularly if you're the market leader in the sense of being the US dollar, to try and talk the dollar down, or to use policies that are not necessarily in favor of a stronger dollar. So that it's really as simple as that. There's nothing sort of mysterious or hidden, I think, in what I'm saying.
Okay, so if you have the US running a higher budget deficit and still running a pretty substantial current account deficit, and you're already buying a lot of treasuries, aren't you shooting yourself in the foot if you guide the dollar lower and then precipitate kind of a mass exodus from the dollar by foreigners?
Yeah, I think I would go along with you, but I think the thing is that there are two things that I think I'd add to that. Is that one is that the equation now has changed decisively in the case of the US, because foreigners now own 40% of the bond market, and it's never really been at these levels before. Equally, what you've got is a very active Federal Reserve, which owns another big chunk, but the issue is that the control of the bond market is rapidly slipping out of US hands. I think the second thing is that if you look, and this is more an observation than anything else, is if you look at the trend in US policy over talking about international policy over the last few presidencies, progressively they've pulled back. So they've gone more and more domestic with each iteration. Maybe starting from George H.W. Bush, where that was probably the high point of US globalization. Every subsequent president, from Clinton through Obama, the other Bush and Trump, etc., has been more and more domestic. And I think Biden is really, maybe the high point of that, where they're going to be a lot more concerned about domestic factors than they are international. And I'm sure that Biden will be prepared to sacrifice the dollar if necessary. I mean, I'm not saying wholeheartedly, but I mean, they will allow the dollar to drift lower. And all we're saying is that, this is a normal cycle. The dollar, normally in a dollar cycle, you see something like a 40% drop in the dollar from peak to trough. That could happen. Let me try and look at some of the other chats that we've got. There's one from Astrid which says, when I say the exchange rate refer to the value of the domestic currency, yes, I do. Another question from Astrid, what are the main components of risk appetite? How does it reflect, how is it linked with each respective equity market? The answer is that the risk appetite calculations that we do are basically based on holdings data. So if I can maybe move a little bit down in the presentation, I don't know if actually I'm going to get out of that. So if I move down in the presentation, back to this one. The way that we calculate risk appetite is taking the data on that left-hand slide and then looking at the proportion that is invested in risk assets that generally we take as equities and corporate bonds, divided by the holdings of safe assets, which are government bond holdings and liquid assets. And that ratio is shown as a time series, a normalized time series on that right-hand chart, centered at 0, which is basically a 3 to 4 year moving average. And then it's normalized, so we set each standard deviation at 20 and 40. So 40 is +2, 20 is +1, -20 is -1, etc. And how does that relate to equity markets? If you're interested, we'll send you a report which catalogs how well or not this analysis works, but it works very well, I can assure you, in terms of predicting equities 1 to 2 years ahead. And what it basically says is that you should be buying equities when you're below the lower tram line in those earlier diagrams, and you should be selling equities when you're above the upper tram line. And it's really as straightforward as that. So that's how that bit works. But I'll make sure, Astrid, I'll send you that. Question from Jeff Keane, which is, if the US yield curve steepens and the euro curve remains anchored by the ECB, does that support the dollar, or do interest rates not matter? Age rate differentials not matter? Well, there's an very interesting point, Jeff. I think there's a lot of economic textbook stuff that basically says that interest rate differentials drive currencies. When I've looked at it and looked at the data, it's almost the other way around. It's actually the currencies drive interest rate differentials, and it seems to run the other way. And Pancho, the sort of the academic view, I still think it's much more in terms of flows that drive the rate differentials. So I think that what you'll see is as those capital flows or cross-border capital flows move, you'll find it increasingly difficult for the ECB to anchor the curve in this way. I think a large part of what's going on in the Eurozone has really just been a dearth of supply of bunds, and that may or may not be resolved in coming months. But there is this big euro issue coming up, and I think the question to raise is, who is going to be buying that? And I would suspect that they're going to be selling an awful lot of that euro debt into the Asian markets. And one of the things that Asia, and particularly China, will want to do is to get more and more off that dollar hook. Now, I think that currency in the next 2 or 3 years is a critical issue, and I think it's not just about cryptocurrencies or digital currencies. It's also what leadership you can get from coming out of Asia for some sort of dollar replacement, and I think that that's more realistic than not. Now, I've spoken about this before. And in actual fact, in the book I wrote, Capital Wars, there's large sections on what China will do. But I think the key thing that will come through is that the way that China gets its currency, more important, is basically to redenominate more and more trade in yuan, and that will create a demand for yuan for sure. It will push the real exchange rate of the yuan up, but they may well have to intervene to keep it down. So I think that what we're looking at is a situation whereby dollar leadership is progressively being eroded. And I've been the biggest advocate of the dollar in the last few years, thinking that the dollar, contrary to what many people were saying a decade ago, was likely to take sort of top slot because of its use in the emerging markets. But I think we're now looking at a different iteration. There's a question I've got from Stefano, which is basically saying, since the Fed can increase its balance sheet as it pleases, if the economy soaks up excess liquidity in 2021, can they step it up enough that markets have plenty for them too? In other words, there's no trade-off. Stefano noticed that in December in 2020, the Fed increased its balance sheet by the 8th lowest amount on record without an evident crisis. I think they clearly don't want to disrupt the markets, but I think it comes back to the point that maybe the ask here is too big given the huge amounts of liquidity that have been thrown in so far, and what the real economy is likely to need. And what you tend to find is that when economies pick up, when working capital demands increase, those are very, very sizable. Now, I'm not suggesting that we're going to get back into a bear market. All I'm saying here is that we may be seeing an air pocket and a nasty correction. And the Federal Reserve, I think is in a situation where almost whichever way it turns, it will be accused of making a mistake. But I think that the Fed doesn't want to pursue this moral hazard thing too much. So I think that broadly speaking, they're going to allow the markets to act as they would over coming months. And I think that even extends to the fact that yields can rise, maybe to 1.5% plus before the Fed acts or says anything, even if the Fed, doesn't have in reality much control left. But I think that generally they will allow the market to sell off if it does without a lot of intervention, on the basis that what you've got is is an economy that's already in pretty robust recovery, and there's an awful lot of stimulus also being thrown at it this year through fiscal programs. So the balance of impetus, if you like, is much more towards the real economy right now than on financial markets. And I think that's the point, the takeaway we're really making. Strong economies very rarely have strong financial markets. And to go back to the others saying, when things look really awful and they just turn bad, you make most of your money. But when they go from looking excellent to just a little bit good, then you've got more of a problem. Hopefully that answers your questions. I think there's another one. Oh, yes, there's another one from Christoph. Let me just read that out. Any views on yield curve control in the US? We've already had a pretty strong forward guidance. We have QE. We've got a 2% average inflation target. Can you argue, and you argue that high realized inflation below nominal bond yields leads to deeply negative real yields, which is a more popular way to decrease the real burden of debt than raise tax revenue. Correct. Yes. Yield curve control. Well, I think that let me address two questions. I mean, one, will you get yield curve control in the US, and will you get negative interest rates in the UK? I think they're different, but maybe we can answer similarly. I think yield curve control is going to be really difficult in the US if inflation begins to pick up, because that was actually what triggered the Federal Reserve to stop yield curve control back in the 1950s. It wanted that extra degree of freedom to allow rates to go up and yields to rise. I think my view on yield curve control is that there may be some desire among certain policymakers to do that, but in practice it's really difficult if you don't control your bond market. And the problem the US has got is that 40% of the bond market is basically held by foreigners. And the Federal Reserve is almost sort of, tapped out in terms of what it can do now. So I think the ability to control it is disappearing. And the question anyway is, do they really want it? And my view, I think, would be probably, summarized by saying, had they wanted to do it, they'd have done it by now formally. There may well be a case to say they've been trying to engineer it informally. Although, if you talk to Federal Reserve governors, off the record, they say that actually they're not doing it, or they don't think it's necessary. So I think there's that. On the UK thing, just sort of briefly, I know there's been a statement one of the Monetary Policy Committee members about negative interest rates. I mean, wow! If you read that research report, it's really, really thin. I mean, if they're making the case, which they are, they want to go to negative interest rates because of what they've seen in Denmark. Well, I mean, good luck on that. I mean, it's absolutely nonsensical. I mean, the real problem they've got with going to negative interest rates is it basically destroys the sort of securitization element in liquidity creation by hampering the repo market considerably. Why would you want to repo your debt if you're going to get negative rates? I mean, it doesn't make any sense. I think that there's a real risk of an accident occurring if they go to that, because you could risk effectively reversing the polarity of the financial system, and which is wholly dangerous. So it would create so much uncertainty, I fear, that it would be a countermeasure, and consequently, I think that central bankers, if anything, should be much wiser to continue with what they know works, which is the QE process. Good. I can't see any other questions, but shout out if there are any. I'm happy to address them. But otherwise, if that's all okay, I thank you everybody for tuning in, listening. And sorry, let me see if there's another. Okay, thank you. Nothing more. That's it. Thanks so much, and look forward to doing the same next month. Thanks everybody for attending. Have a great day. Bye.
Thanks, Michael.
Thank you.